Welcome to my 2021 State of the Construction Industry presentation. My name is Bill McConnell and I work with the Vertex companies. Vertex is an AEC firm with offices throughout North America. I hope you enjoy this presentation. This three-part presentation covers the state of the U.S. economy, the state of the U.S. construction industry, and the state of the U.S. contract surety industry. Based on my analysis, 2021 is going to be a very difficult year for the U.S. construction industry, which is typically the case in the tail end of a recession, in the year that follows a recession, when backlogs shrink and poor decisions are often made as contractors fight for survival. As FDR said on December 7th, 1941, that was a date that will live in infamy. Well, for me, 2020 is a year that will live in infamy. It was filled with civil unrest. There was a severe recession. There was a crazy presidential election. There was, first and foremost, COVID that took the lives of over 400,000 Americans. There was a switch to remote learning, which my two daughters hated. And then there was remote working. So it was a crazy, crazy year. The state of the U.S. economy is in flux right now. Since the collapse in Q1 of 2020, there was a V-shaped recovery shortly after that collapse. And that was followed by a third wave of COVID and the resultant shutdowns. Now, as of January 18th, 2021, soon to be head of the Treasury, Janet Yellen, is pushing for a $2 trillion recovery package, which would certainly stimulate the economy. But the question is, will this happen in time to prevent a prolonged recession or a double dip recession? Only time will tell. The National Bureau of Economic Research is the organization that the federal government looks to, particularly the FOMC, looks to determine when a recession started and when it stops. And as you can see here, back in June of 2020, they noted that the 28-month expansion ceased in February. It was the longest expansion dating back to 1854. So that's actually when the recession indeed started, and we'll look at the recessionary cycles in the next page. This graphic shows the recessions that we've had since the 60s. This is that double dip recession in the early 80s. But as you can see here, based on the MBER article, this most recent recession started in February 20. Now, it should be worth noting that the MBER won't tell us when a recession ceases until 4 or 5, maybe even 6 months after the recession has ended. So we don't know if it's stopped at this point or if it's continuing, but they're likely going to note that it did continue through 2020, and we'll find out when it in fact stopped, likely later this year. Here's an illustration of a double dip recession. If you consider GDP is on this y-axis, you take a look here. Here's a peak business cycle. GDP growth was at its highest. Its output was at its highest. And then the output troughs, and that's the recession one. Then there's a brief recovery, followed by a second recession shortly thereafter. And this axis is time. So what we have experienced is this date here would be February of 2020. And then there was a brief recovery from approximately May through September of 2020. And then we had that third wave of COVID cases hit the United States. So, and the result of that was some shutdowns, governmental shutdowns, and the economy was moving at a much slower pace. So the question is the NBER going to consider that brief recovery an actual recovery and then split 2020 into two recessions? Again, it's only happened twice in the past 90 years, and it happens when the recovery, and then it's followed by reduced spending and rising unemployment. So if we see that 6.7 unemployment number increase, it might indeed be a double dip. Here is the graph of the COVID cases in the United States. We've had that first wave, second wave that was from June through about August, And then this third wave really started in October, and it was very severe. As you can see, we're talking in the hundreds of thousands of cases a day. And this is the concern about the double dip recession. Will this create such a slowdown to cause either a double dip or a prolonged recession rather? Now that we're here in January and we do have vaccines, that is certainly good news, but it's something to keep an eye on. Per the CDC, as of January 17th, 2021, approximately 7.4% of the U.S. population has or has had COVID, and that's 24.4 million divided by 332. In order to get to herd immunity, you have to reach a factor of 10x of that number. So that likely will not happen. On a bright note, the total vaccine doses distributed over the last 30 days or so is over 30 million. Only a third of those have been administered at this date, but that is good news, and I'm hopeful that a good chunk of the overall U.S. population will be vaccinated over the next 6 or so months. U.S. unemployment rate. Take a look at this. It peaked at 14.6%, I believe, just under 15% back in April of 2020. We haven't seen the likes of that number since the late 30s, and as you can draw a line across here, we haven't even come close to that over the last 90 or so years, 80 or 90 years. So it was severe, but you also saw a very steep reduction. When you look at recessions, typically unemployment is at a different slope, and a lot of times it doesn't come down until after a recession has ceased. And as you can see here, as we go back, it almost happens to all of them. So is NBER going to say the recession ceased really in May or so of this past year? I don't know, but we'll likely see this figure start to flatten through at least the first half of 2021. Here's real GDP growth quarter to quarter. And as you can see, 5% growth is known as very, very good growth. Oops, my drawing's not so good. But we haven't hit 5% in 20 years. So 2010s were a slow growth decade. It did pick up slightly at the end there, and the last 3 years or so, but really overall, we never hit this 5% mark. But what did happen in Q1 of 20, we saw a 5% decline, and then we saw a 31% reduction in Q2. But then we saw a significant bounce back of quarter over quarter growth of 33%. And this, we're probably going to see growth from the fourth quarter as well. We'll see how that flattens out, though, based on that third wave of COVID cases we talked about. But this is a wild, wild year right there. Here we have GDP again, but this is annual. So these are quarterly numbers, but it anticipates GDP growth at an annual basis. When you look at the Great Recession, I think that's Q3 of 2009, it hit about -4%, and then it eased back into something less than that. And when we look at this recession, boy, I think that's Q2 of 2020, we were north of 8%. So it was 2x plus of, when you compare it to the Great Recession here. But as we see in the third quarter, because of the growth, quarter over quarter growth, that 33% growth we talked about, it's eased back to about a little over 2%. And in Q4 is probably going to be the same. So it's probably going to be really a year over year reduction of about 2%. So it actually will be less severe in the long run, but that one quarter was extremely severe. but it is easing back. The Dow Jones Industrial Average collapsed in February, and the collapse ended in April, and there was about a 37% dip. And recall, if you drop by 37%, it takes more than 37% to get back to where you were at originally. And what in fact happened was the market rebounded by 66%. So not only did it get back to where it was, it eclipsed it. And there was a very obvious V-shaped recovery in the stock market. Many articles in 2020 talked about why the stock market was booming when we were in a recession. And it is because the stock market prices out tomorrow where economic indicators note where we are today. And the stock market is, they say 3 months, maybe even it's more than 3 months at this point, but the stock market is bullish on the future in 2021, which is positive. I believe they see additional spending taking place. So we have seen really the stock market hit record highs over the last couple months. Inflation is traditionally measured by movement in the consumer price index. Here is percent change month over month of the CPI. And if you look back in 2000, you see during the recession, there was really very little deflation. There was significant deflation in 08. And as you can see in 2020, there was a dip. And like 08, it was followed by a big boost, and then it came back, and then economists are concerned about this guy right here as inflation is ticking up right now. And if there is a stimulus package in the trillions of dollars, the biggest fear is that inflation will be back. And when you see inflation, then there needs to be rate hikes. And as we all know, once there's rate hikes, then there's oftentimes recessions that follow shortly thereafter. So what we can see here, if we were to look at an average change, and my drawing's bad, but where we're at right now is very average, and it's nothing to be concerned about. So all of the talk these days is speculation of what additional stimulus funds will do. But as of right now, inflation is in check. The yield curve is very complicated, but it is the indicator for recessions. And it's basically the 10-year Treasury yield minus the 2-year Treasury yield. And what that means is that when there's a flight to safety, after there's an expansion boom and there's late cycle, there is money that's pulled out of the equities market and put into more low-risk assets like a 10-year Treasury yield. And as a result of that, so much money gets poured into the 10-year prices and yield drops. And then that ultimately drops below the 2-year, and then the curve goes negative. And as you can see here, in every recession since the 1920s, when the yield curve inverted, which means it went negative, that is when a recession is on the horizon. Now, believe it or not, in August of 2019, this did go negative for a day or two. And what that means, when you see that negative number, you got 6 months or so, or within a year, you're typically going to see a recession. And that's exactly what happened in this instance. I know a pandemic is not something you predict. So really the economy was headed towards a recession regardless, but it just so happens it was triggered in February by the COVID cases in the US. And again, you had that August to February, that differential. So approximately 6 months did in fact occur here. And once you get that negative yield curve, it starts to steepen. And that's what it does through the recession. That's exactly what we're seeing now. And that is a sign of expansion. That means when it's steep, people aren't investing in bonds. They're investing in the stock market. And that's exactly what we saw over the past year. And so it's something to keep an eye on. the federal government controls the economy with the federal funds rate. So when we enter a recessionary cycle, the government reduces interest rates in order to stimulate spending. You can see that in the 90s, the 2000s, 08, and most recently, 2020. And so mid-cycle, in the 90s, it kind of happened in 93, but there was almost a quasi-recession rate here. But in any event, you saw mid-cycle in 04 and mid-cycle, let's say in 15, 16 of this last expansion cycle, things start heating up. So they cool down the economy with an increase in rates. And then that causes the economy to slow and oftentimes leads into a recession, which is just a quick correction. And then all of a sudden, through the correction, the economy is stimulated through lower rates, and that's exactly what we have here. We're back at zero. And really, the 2010s, that first 5 years, they held it at 0% because the growth just wasn't there. So we'll see, again, it's worth keeping an eye on. That is the indicator on whether we're growing or not, is if they start ticking up the Fed funds rate, that's when the economy needs to be cooled. Federal debt as a percentage of the GDP peaked just after World War II at about 120%. That's not good. And then look at the US. They got their balance sheet was really in order, very healthy by the 60s, 70s, and 80s, where we had debt as a percent in maybe the 30% level. But since then, since 84 or so, we've been deficit spenders. And now our debt as a percentage of the GDP is north of 100%, and it's trending upwards based on the most recent recession. So the main reason I don't like this graph is because it impacts public construction spending. When we have a healthy balance sheet, there is larger investments. Think of the 50s and 60s and 70s. The investments that were made in the US infrastructure were extreme, and then it's just slowed over the past 2 to 3 decades. So in sum, regarding the US economy, there was indeed a market collapse in Q1 of last year, which ended the longest economic expansion on record, and it was followed by a V-shaped recovery. But the question is, will there be a double dip recession based on the recent lockdowns and the continued COVID cases? And that will largely depend on how quickly they can roll out, states can roll out the vaccine distribution. Unemployment rate went to an unprecedented 14.7%, but dropped down to 6.7% by year end. COVID cases are closing in on 10% of the population, but 30 million vaccine doses have been distributed to date. That's good news. Real GDP was down 5% in Q1, 31% in Q2, but then rebounded very nicely in Q3, up 33%. It'll likely flatten out from there. The Dow Jones Industrial Average dropped 37% between February and April, and that was followed by a 66% rebound. Crazy rebound. The CPI dipped and then rebounded in 20. It didn't dip all that far when compared to 2008. And the question now is, will there be inflation from here forward, and will they start ticking up the rates? Fed funds rate is back to zero, however, and if you ask me, it's going to stay there for at least a year or two. Federal debt as a percentage of GDP is north of 100. That's putting the squeeze on public construction spending. And the bottom line, it's looked like we're actually in the start of an expansion cycle, and that will continue unless there's further shutdowns. All things considered, the construction industry performed remarkably well overall in 2020, but 2021 looks to be a very tough year for contractors. The backlogs started to shrink throughout 2020, and the industry awaits an infrastructure bill, which won't take place for several months. So spending's the problem. Not having the backlog typically causes poor decisions, as we'll talk about in this section. So based on this Q3 E&R article, construction executives believe that the downturn will continue until late 2021, and it's worth noting that construction executives are perhaps the most optimistic group of people you'll ever meet. As we moved from Q3 into Q4, industry execs continued to believe that late 21 will be the turning point of the industry. So they continue to believe that 2021 will be fairly tough. Again, because these execs are typically very positive, when they are pessimistic, you know things are pretty bad. So here's the confidence index that ENR maintains, and basically anything north of 50 shows expansion, anything south of 50 notes that the industry is shrinking. And back in 2018, you saw these fairly high levels of confidence. It was waning in 19, which made sense because the industry itself was in a very late cycle, historic cycle. And then in 2020, after Q1, we have these extremely low levels of confidence, and we see that reflected in that Q3 and Q4 quarterly report, those slides we just looked at. Here we have ENR's review of the various construction sectors, and you have here declining activity currently, and then you have 3 to 6 months out, and then you have a year or so out. So not unexpectedly, you have commercial offices, very low prospects for growth there, as well as entertainment, theme parks, cultural, to be expected. Also hotels, people aren't traveling, hospitality is getting hit pretty hard and will continue to be hit pretty hard. And then we have retail, again, with the lockdowns, less spending. Many of the shopping centers aren't open throughout the country. And then petrochemical, oil and gas, is hurting, although the prospects are a little bit brighter than those other sectors that I just spoke about. CFMA also maintains a confidence indicator of construction financial professionals, and they are predominantly CFOs, which I must say are the most pessimistic of the optimistic crew. And what this indicator does is it maintains 100 as a neutral level. Anything above 100 is optimism, and anything below 100 is pessimism. So, and it's somewhat of a forward indicator. So you can see here in 17, 18, and 19, the industry was fairly optimistic. It did dip down. The first half of 19 was not so great, but now after Q1 of 2020, we see these lower numbers in the 90s or below. So again, they have a very similar sentiment where they're very low confidence on the overall industry. This is a graph of AIA's Architectural Billing Index, and it hit a record low in 2020. So it tracks both billings and backlog. And as you can see through recessions, you'll see a decline and you'll see a decline. And here we're in a decline now, but it's extremely extreme. It has bounced back to the 40s at this point, but it is very low. And this just suggests that design backlogs are shrinking. And as a consequence, you're going to see construction backlogs shrinking as well. And here we are of a detailed breakdown of November ABI breakdown. Again, anything below 50 is bad, shows shrinking. Anything above is growth. And design contracts actually, in October, it showed a little signs of life, but it dropped again because of the lockdowns. So again, we are in this compression mode for design contracts, which spells trouble for construction contracts. PSMJ did a study here that was published by Construction Dive back in July of 2020. It noted that AEC proposal activity was at its lowest level in a decade. Not surprisingly, we're looking at restaurants, hospitality, commercial office, etc., that had the most reductions in proposal activity. But this is just consistent with the ABI index and the confidence levels. The issue at bar is backlog, and that's typical through a recessionary cycle. So here's ENR's cost forecast for various indicators. As you can see, this is the forecast for where we're going to be in terms of BCI and skilled labor. As you can see, these are pretty flat numbers when you look over the last 10 years. They're much lower than they have been, which is actually a good sign because there was a massive construction inflation between 2016 and the first part of 2020. But what is of interest is residential products. I mean, look at this number right here, 25% increase between 19 and 20. The residential sector was unaffected. In fact, it continues to boom, which is an amazing thing. We're seeing mostly single family growth, not so much in multifamily, but you are seeing these wood and gyp products really escalate, which is something of concern for residential building contractors and developers alike. Dodge lists construction starts on a monthly or quarterly basis, and they also assemble annual data, and here is that. As you can see, through the last decade, we had massive growth in construction starts. It was a great run, it really was, and now you're seeing that slow, which is not unusual. Here you have kind of through the early part of the recession, December of 08, down to 2009, which was the end of the recession. We had declining starts. Here we're showing a decline and actually a little bit of an uptick between 20 and 21 is what they're forecasting. So that is actually a very positive sign where you have increase in starts, which suggests that the recession may be over now. And we're showing a little bit of growth in starts. So that is actually a good forecast. The public construction sector has been waiting many years for an infrastructure plan to pass through Congress. Well, it looks like it's going to sail through in the next couple months. Biden hasn't unveiled his infrastructure proposal, the exact numbers, but it is coming very shortly, and it'll likely get through Congress in March or April of this year. The Biden administration recently noted that its first piece of legislation will be a recovery plan that will go through Congress fairly quickly, I would think, over the next month or two. And then the second plan, or the second piece of legislation, will be an infrastructure plan. And they're expecting that that's going to be in the next several months. So again, that is a great thing for the public construction industry. ABC does a great job with his construction backlog indicator. As you can see here, backlogs grew, and we're pretty stable through 19. And then we see a big drop in backlogs in 20. And that's a result of the recession. We also see sales and profit margins dip and staffing level requirements ease. So really, this 50% mark is where we have growth in compression. And we've been down at this kind of level here. So we are seeing backlogs dip, which we all know is the cause of many problems in the industry. We saw that graph a couple slides ago about the federal debt as a percentage of the GDP. And the reason why it's going up and up and up is we have mandatory spending, interest amounts that are due, Medicaid, Medicare, Social Security. Well, these mandatory spends are going up. And as I mentioned, when that goes up, investment in things like public construction goes down. So back in the 70s, there was 30% spending of investment on things like roadways and public infrastructure. Now that's down to 13%, and that trend will likely continue. So that's not a great stat for the public construction markets, but hopefully this infrastructure plan will renew the need for infrastructure money. The demand is certainly there. In the AGC's outlook for 2021, they first note that most contractors expect demand for many categories of construction to shrink in 21, and few expect the market to recover to pre-pandemic levels for more than 6 months. In addition, they note that 2021 will be one of the most difficult years for the construction industry since the recession of the 2000s. So outlook is dim. It's dim in 21, and AGC is typically fairly optimistic crew. But 2021, contractors pay their bills based on backlog because they need backlog to cover G&A, and there's going to be some tough decisions that need to be made. So at least the first half of 21 will be difficult for most sectors. Here's the Census Bureau numbers on the construction industry, and as you can see, the market, believe it or not, total construction was up 3.8%. I mean, that's just a baffling number based on everything that happened. And the reason why it's up, well, look at that, 16.2% residential was up. I mean, it's almost back to a $700 billion industry. It's massive, and it continues to do very well, and it really supported the industry because when you look at non-residential, it was down by 5%, and you look at all these negative numbers down here. It's crazy, except for public safety, I believe. Yeah, that's right there. But so non-residential sectors got smoked in 2020. Residential just had a record, almost record year, almost like a 2006 level type of year. Here's a breakdown of private construction versus public construction put in place. As you can see here, private construction is over 3 times the size of public construction, and they were both up year over year through November. 4% for private, 3% for public. In terms of private, it was 100% and then some due to our residential construction work, up 16%, banner year. In fact, look at these numbers, 566 billion, and it jumps to almost $100 billion to 658. Back in 06 and 07, the residential industry peaked at just under 700 billion. So it's encroaching on that number. It dipped to about 200 million, and then it has jumped all the way back. So it's really carrying private construction in terms of non-resi work. It's down almost 10 points. So it was a very difficult year, 2020, for non-resi work. Same holds true for public construction. However, when you look at the number 1.1 trillion versus almost 700 billion, that makes up over 50% of the overall private construction category. But here we're looking at 8 to 9 billion of the roughly $350 billion market. So it's really 2 to 3% of the overall public construction market. So it's very small. So it did jump 24%, but it didn't have the impact to elevate the overall public construction industry all that much. But here we have 2.6% for non-resi work on the public sector side. So it was a decent year overall for public construction. Here's overall put in place construction. The 90s were a great steady year or steady decade for construction. The 2000 recession, things flattened out. And then we had that residential boom through the early 2000s and mid 2000s. And then once 2006 hit and defaults started, the industry itself lost 1/3 of $1.2 trillion, went down to 800 billion. So that was a massive impact to the overall industry. And from 2011, 2012, the industry has grown very nicely. In 2018 and 2019, we did have this little dip here that was due to the rate hikes, and that slowed down residential construction. And when those hikes were reversed, we saw a boom, and then we saw the COVID pandemic hit in early 2000, and it dropped, and then thanks to residential, it came right back. So currently, we are at a record level of construction at 4, 5, 6 trillion, and that is largely, almost 45% is based on residential construction. But it's the 2010s were a great decade for construction, but we are likely in a scenario like the 2000s where we will flatten out over the next year or two. Public construction spending grew slowly but steadily through the 90s, and then it really picked up in the 2000s. But since the 2000s, it was a $320 billion industry. And look at the performance through the 2010s. It took until 2018, 2019, just to get back to where it was in 2008, 2009. But the last part of the 2010s, it really started to pick up steam. And then it slowed. Again, put in place construction was affected by COVID. And then it started to rebound a bit, and it has rebounded, but it's likely gonna flatten out, at least for the first half of 2021 until stimulus funds are deployed. Private construction grew very nicely through the 90s, and then you can see this was incredibly steep. And here was your big bubble, and then that bubble burst, and then we saw the industry itself of private construction, and we went from 950 to about 500. So almost half of the industry disappeared in the Great Recession. And then since 2011 or so, it's been a nice ride, real nice ride for the past 10 years. And now we find ourselves in a recession, and we're likely going to see something like this, the 2000s, where it's flat. Hopefully we'll never see this type of decline again. So again, if you were to forecast what's going to happen over the next year, you're going to see just flat growth. The residential sector right now is, if you go across here, it's about $666 billion in size. It's by far the largest sector in the construction industry, which in total is 1.46 trillion. So it represents about 45% of the overall industry. In the early 2000s, you saw this amazing growth, which was fueled by subprime mortgages, and then there was the collapse due to the defaults, and it collapsed down to about $250 billion. So it lost about $450 billion worth of put in place construction between, let's see, 2006 and 2009. And that was, I think, a collapse of 64% of the overall market. And between 09 and 12, it was flat while the banking industry figured out what they were doing with residential loans. And once that got figured out, there's been really steady, unabated growth until 2019. And in the first half of 2019, you started to have high interest rates. The rate, Fed funds rate, had been ticked up 9 times between, I think, 2015 and 2019, and that eventually had an impact, and growth slowed. Contractors stopped building residential houses, and then in mid-19, they dropped the rate, and then you saw an immediate spike again. And then during the collapse, a couple months of the collapse in 2020, we saw a reduction, and then, boy, look at that quick turnaround. And that continues today. And rates remain low. So if rates remain low, you will see quite a bit of residential developments going up, so long as there's a demand for them, which it continues to exist today. Non-residential construction spending has been pretty choppy over the last 10 years, but let's say for the past 5 years it's grown nicely. However, over the past 10 months, it's been on a steady decline, and that's likely going to continue that way as projects for hotels and commercial office buildings and entertainment, etc., retail, those are mothballed at this point. A lot of them have been mothballed, so we'll likely see that continued decline I would say it's a similar type decline as we saw after the '08 recession. So these are sectors that will be hit the hardest, have been hit the hardest, and will continue to be hit the hardest. So here is initial jobless claims posted by Fred, and it dates back to the 60s. And as you can see, I mean, this is just insane numbers, unprecedented again, and then an immediate drop thereafter. But it shows, again, the severity of what 2020 held. So the question is the housing market in a bubble? Is it like '08? Well, the answer is no, because there isn't an issue with subprime mortgages at this point. What happened was people weren't simply selling their houses, and builders built their houses slower due to the pandemic, and then there became a massive demand, and the housing market boomed as a result. And it really drove pricing up per square foot. Overall, I believe the pricing of a house was up 10% in 2020. That will likely not continue as more product is coming online and supply and demand will level out. But again, it was quite a ride for residential markets, like particularly markets in Florida and those in the South, which are people are buying second homes down there. Here's the construction employment picture. Here you have in '08, '07, you had employment of about 7.5 million. It dropped down to 5.5 million and went up to about 7.5 million in 2020, and then dropped by about 1 million people to 6.5 million. But you can see that little spike right there, and it hasn't gotten, all of the people are not all back to work, but you know, having a little breather in terms of labor actually helps the industry, because there was such a shortage over the last couple of years as all of these additional folks were put back to work, and the supply of workers really became the issue in the industry between 2016 and early part of 2020. Here is construction unemployment, and this past, or the current recession, did not top the 25% mark as we saw back in the day in '08, '09. And again, that was largely from the residential sector that burst after the subprime lending scandals came to light. And it does happen to be the largest, by far the largest construction sector. Here, we got north of 15%, which is quite unusual. But unemployment dropped till about 7%. We're in the winter months, so we will see that spiking for the next couple months. But again, less severe than what we saw back in '08. Here is an E&R article which notes that most firms are relying on large backlogs from the boom years to get them through until the market bounces back, and they're scrambling for new opportunities. Again, traditional recessionary cycle leads to shrinking backlogs, and then oftentimes panic leads in, and then poor decisions are made. And that's just the way it goes for our industry in nearly every recessionary period. In 2016 through 2019, there was labor shortages, there was record revenues, and that all equaled scheduling quality issues. And that's really what we saw over the past several years. But in 2020, that reversed, and let's go to the next slide. In 2020, we saw backlog reductions, and that typically leads to poor decisions, and that generally manifests in shrinking profit margins and bankruptcies. Those bankruptcies typically happen in a fairly large wave a year or two after a recession ceases. And here's your typical economic cycle in the construction industry. You have a recession that'll last 1 to 2 years. You have shrinking backlog, low margin work. And then you have early expansion period where there's actually fallout. That's when the contractors fall out. And that's when we do see project losses and shrinking profits. And then if you can get through that early expansion year, contractors really take advantage of mid-expansion and late expansion phases of a cycle, and they, last, if you look at the last 30 years, they've lasted. Those mid-expansion and late expansion collectively are about 5 years, and those are growth years, increasing profits, and then ultimately there's escalation because of the workforce shortages and material shortages and cost escalations, and then you have those project issues I mentioned about quality and schedule, and then you're back to a recession, and then you have the shrinking backlog, lower margin work, and it's just a vicious cycle. So it is very important for contractors to understand where we are in this cycle. Now we're heading into an early expansion year, and those are the toughest because through a recession, contractors typically have backlog to get them through the recession, but it's that work that contractors take on during a recession that hits them hard in early expansion years. And here you can see Census Bureau or Bureau of Labor Statistics data. In 2007, there was almost 900,000 construction establishments, and that troughed in 2013. So you saw that continual reduction in establishments, a vicious drop between 07, really 08 is when it hit. You can see from this point forward, downward to 13, you came down to about 750,000. So 150,000 contractors were lost during those years. And now we have this expansion cycle between 13 and 19 and 20, really. And then you're going to see this downward trend from here. And that's the fallout, and that's why you see surety losses, contract surety losses peaking several years after a recessionary cycle. So in sum, regarding the construction industry, the industry actually realized growth in 2020 because it was deemed an essential industry by the federal government in most states. And in addition, we saw the residential markets absolutely booming in the second half of 2020. 2021, all indications are it's going to be a challenging year. You look at the reports from construction executives, and you look at the architectural billing index and other indicators. Design and construction backlogs are shrinking, starts are slowing, and confidence is low. So it will be a traditional either post recession year, early expansion year, which are difficult. And it's challenging time for contractors to remain disciplined and not take on low margin work. Construction inflation has eased with the exception of residential materials. We've seen that. Biden's infrastructure plan should sail through Congress in March or April, which will help public construction spending. Workforce shortages, which plagued the industry for the past 4 years, is no longer a major issue except in certain residential markets. In addition, the industry will likely improve as 2021 goes on. So the Q1 and Q2 of 2021 will be difficult, but then we should see some expansion at the latter part of the year. In terms of the surety industry, the contract surety industry, the industry itself has performed extremely well since 2013, which was, again, getting beyond those early expansion cycle years. And since then, on the contract side, overall the industry's performed extremely well for a decade, but on the contract side, it's been really since 2014 or so. Through 2020, it's been a great 6 years. It'll likely perform well in 2020 Q4 when we get those results for the last quarter. And 2021, we will see losses trending upwards, and the next couple of years will be a little more difficult for the industry. The question is whether it's going to be a major loss cycle or minor loss cycle. Here's my surety loss cycle review. As you can see, we had a major loss cycle in the 80s, followed by a minor loss cycle here in the 90s, and then in the 2000s was another major loss cycle, and the 2010s was a very, very minor loss cycle. And now that we have the 2020 recession, we've started another loss cycle in the 2020s. And you can see here, if you can see that where I'm drawing, there's been a minor uptick in surety losses. But when you look at the last 10 years, I mean, the losses have been flat, and you've seen some really healthy premium growth. I'm anticipating that the premium will be flat in 2020. The final numbers aren't out, but when you project forward Q3 results, it shows to be a flat year with about $7 billion in premium written. And so we're kind of due for a major loss cycle, I hate to say, but we'll see. Although this last recession was extremely severe, it was short. And if backlogs can come back online, then we'll likely see a loss cycle that maybe is a medium in nature, if you will. There has been a lot of new entrants into the surety marketplace, and that usually bodes for more severe losses. But we shall see. But really, 2019 was really the end of the last loss cycle, as we've seen, albeit mildly, surety losses ticked up from about 19% to about 22% in 2020. Here's SFAA data, and it's based on contract surety bond performance for the industry from years 2006 to 2017. When you look at the direct premium written, and then you have the direct premium earned and direct losses incurred, and then loss ratio. Loss ratio is direct losses incurred divided by direct premium earned. And when you look at these 2 years highlighted in blue, you have, those are the recessionary years of the Great Recession. I believe the recession ceased in June of '09. And then you look at the 3 years following that recessionary year, you see the loss ratios really jump beyond what you saw in '08, '09. And this is typical of a surety loss cycle where you have the end of the recession and then the 3 years beyond that recession. In fact, this one actually lasted a couple of years longer than that. You have these larger loss ratios beyond that, but really this is what you normally see as increasing loss ratios in those 3 years. So we would be, if we were to liken 2010, we would liken that to 2021. So we'll likely see the loss ratios tick up this year and the following 2 years, and then we'll be through the early expansion phase and into the mid-expansion phase, in which case you typically see some great results into the late expansion. As you look here, the late expansion years of the 2000 expansion cycle, I mean, '08 was at 6 points, and then you have 16, 17, and we went through 18 and 19 were all under 20% loss ratios, and it appears that 20 is just going to be just above 20%. So again, we'll likely see the trend for the next 3 years, loss ratios increasing. Now, this is a minor loss. I call minor loss cycles ones that don't get above 40%. If this one is major, we will see loss ratios tick above 40, but it's a little too hard to tell right now. Here's a graph of direct written premium in light blue for the surety industry and public construction spending in dark blue. As you can see, the trend is very similar. We had the surety industry over the last couple of years outpacing public construction, but public construction is caught up, and it looks like it'll, in 20, I projected this based on Q3 numbers. So really, if you're going to measure how the surety industry is going to perform in terms of premium, you really need to look at public construction spending. And with the Biden plan likely going to run through Congress pretty quickly, that spells good things for surety premium. It's just a function of, can the industry manage its losses for the next 36 months? And if so, this amazing track record will continue, and if not, it will be a blip for 2 to 3 years before it really starts performing well again. But it's to be determined. Here we have the SFAA's Q2 results from 2020. As you can see here, estimated loss ratios are 20.9%. And on the next slide, we're going to see how that compares to Q3 to see if the losses are increasing throughout this tough 2020. And in fact, when you look at this slide, losses have jumped from 20.9 to 22.3, which is to be expected based on what transpired in the first half of 2020. It should be interesting to see what the full year looks like. I projected in my numbers that the full year was going to show that 22% loss ratio number. The surety industry realized massive consolidation. When you look at the 80s, the top 10 surety providers only had 21% market share. That doubled in the 90s, and it grew by 50% by the early 2000s, and it was up to almost 70% by 2008. But then look at what's happened since then. That market share has actually decreased by 8 percentage points from 68 down to 60% as of 2020. And that's a result of a lot of middle market players getting into the surety industry. Also, the middle market players have become a little more aggressive than perhaps the top 10 players. So you are seeing that market share dip, which I think is probably a good thing. I don't know if having 70% of the market controlled by 10 companies is good. We're still 50% north of what it was in 1990, but it has since really 2016, we've been right around that 60% mark. So in sum, surety losses tick upward in 2020, but remain low, which is typical for a recession year. Currently, they're just north of 20%, which is still a very good year, and that's typical for a recession year. Sureties generally never get hit in a recession. It's the years after. Surety losses are going to continue to tick up for the next 2 to 3 years. If it's based on a typical cycle, the early expansion years are the hardest hit for both contractors and sureties, and that's usually a 36-month process. And the market share of the top 10 surety providers has gone from just under 70% down to about 60% as middle market entrants have jumped in and are taking market share. I mentioned here that there's some benefits of shrinking contractor backlogs, just about none, but for sureties, there will be more attraction to relet work. Getting additional bids themselves will be much easier. Relet pricing will be more competitive, and escalation is eased somewhat. So at least in non-residential products, which generally is what surety is involved with. So we should see on the claims front, pricing coming in a little bit more competitive. So in sum, 2020 was certainly a crazy year. We find ourselves in a recession. That happens every 6 to 10 years. And the economy, which crashed in Q1 of 20, rebounded swiftly. There was a V-shaped recovery in very short order. The question is, will that recovery continue, or will that third wave of COVID cases that started in October of 2020 slow spending, and will it cause a double-dip recession or a prolonged recession? Only time will tell. In terms of the construction industry, it performed well, largely because it was listed as an essential business and because the residential markets ripped. That'll probably slow. 2021, particularly for non-residential markets, is going to be a very tough year due to shrinking backlogs. When backlogs shrink, that's when we have fallout several years later. Poor decisions are made, unprofitable work is taken, and that ultimately leads to fallout. And that will likely occur in late 21, 22, and 23. On the public sector front, the good news is that Biden's infrastructure plan should move through Congress, and that should be in place by, let's say, April of this year, which should result in money being deployed into the public construction industry by late 21. Contractor losses will trend upwards over the next several years if historical trends hold true. And lastly, the surety market has entered a new loss cycle as the 11-year bull market came to an end. And so we will see contract losses trend upwards for the next several years. And then they will ease as we get into a mid-mark and late market cycle. So thank you very much for listening, and I will see you next year.